Hello friends, I am Varsha Sharma, working as an assistant professor in the Biyani group of colleges. On the behalf of CAPM, today I am presenting a lecture on the topic of capital asset pricing model. Generally, the investors are the risk averse. Total risk consists of two parts, systematic risk and the unsystematic risk. Systematic risk are those risks which we cannot diversify very easily. It is also known as a market risk or the non-diversifiable risk, for example, inflation. Second risk is unsystematic risk which we can diversify in the organization. For example, union strike. Union strike, we can stop or finish the union strike by providing the various fringe benefits to the labor. The total risk of the diversified portfolio depends on the systematic risk. The standard deviation of the individual security does not indicate that how will that security will contribute in the risk and return profile. So another measure is needed. The another measure is capital asset pricing model. Capital asset pricing model is developed by the William F Sharpe. This model shows the relationship between the systematic risk and the return. Systematic risk and the return. It can be expressed through the following formula. R bar is equals to RF plus beta, RM minus RF. RF denotes to the risk-free rate of return. It is a government securities. Say plus beta. Beta is a Greek word. It denotes the systematic risk in this formula. In this formula, beta is equals to 0 means government securities. Beta is equals to 1 means market securities. And beta greater than 1 means security has a greater risk than the market, and beta less than 1 means security has a less risk than the market. RM minus RF, this segment shows the risk premium. Risk premium means the excess return or excess return over or above the risk-free rate of return. From this formula, we can find out the expected return through the capital asset pricing model. There are some basic assumptions of the capital asset pricing model is market is perfect, means all the securities are marketable, there is no transaction cost, no taxes. Second one is risk-free rate, means all investors can easily borrow or invest their own money. Third one is homogeneous expectation, means every investor has a homogeneous expectation regarding the interest or regarding the returns or a risk. Fourth one is time period, it focuses only a one time period. And last one is diversification. Capital asset pricing model holds a diversified portfolio. The graphical representation of the capital asset pricing model is SML. SML means security market line. It can be represented through this diagram. In this diagram, on the O axis we take the beta and on the O y-axis we take the expected return. Here the horizontal line shows the risk-free return. Risk-free return means there is no risk. It means government securities. And here upward sloping is SML line. SML means security market line. The upward sloping of SML line shows the linear relationship between the systematic risk and the return. And the difference between the return on over and above the risk-free return is known as a risk premium. Here, this diagram shows that the return above the risk-free return is known as a risk premium. So friends, for the further information, please visit our site www.guruKPO.com.